details of the valuation. It's more about finding a range and whether you think that's reasonable or whether you think it's exact. And what is that Buffett phrase or Charlie phrase? I'm going to blank on it. It's better to be, help me out here.
Approximately right than precisely wrong.
Thank you. Yeah. It's better to follow that advice than anything else. So yeah, that's my pick.
I love this podcast because it crushes your dreams of getting rich quick.
They actually got me into reading stats for anything.
You're tuned in to the Investing for Beginners podcast.
Led by Andrew Sather and Dave Ahern.
Step-by-step premium investing guidance for beginners.
Your path to financial freedom starts now.
All right, folks, welcome to Investing for Beginners podcast. Today, Andrew and I are going to talk about a checklist. We're going to talk about Monish Pabrai's, maybe not his exact checklist, but a checklist built on the ideas that Monish Pabrai has prepared for us. I read a book that he wrote many years ago called The Dhandho Investor. And in that book, he talks a lot about checklists and the importance of checklists. And he kind of gave a framework for checklists. And so I wrote a blog post that Andrew recently updated that was a blistering 5,000 words. He has made it more manageable for everyone to read, and we will include that link at the end of the show so you can check it out. But we thought we would talk through the checklist, and we're going to do it a little different. We're going to do it like we are fantasy drafting our football team. So we have, I think, questions, I want to say 34 questions in that range, 34. Yep. Yeah. And we're just going to kind of go through this and pick the ones that we like the best. So you don't have to listen to all 34, but you can read the blog post and check them all out. So with that, Andrew, first serve or first pick is yours. Where would you like to start, sir?
This is a lot of pressure because I know just how important that first pick is. I'm going to hope for my Jonathan Taylor. Here we go. There's different pillars. This one has to do, it's technically under management, but I feel like it encompasses the entirety of everything we're trying to do. So the one I'm picking is, what are the future prospects of the business? We have to remember, as investors, we are not buying what a business has done up to this point. We are buying what is the business going to do in the next 5, 10, 15, 20 years. And that's really everything kind of boils down into that. The past can be helpful in giving us hints and clues as to what makes a business strong or what's driven its growth, and, help us pick out businesses that are great versus businesses that are average. But at the end of the day, that famous quote, you've heard it over and over again, and if you haven't, you should memorize it. Past performance does not guarantee future results. So true in the stock market, so true with businesses. So when I'm looking at a business, I want to know, what are its future prospects? And am I doing as much as I can, as much research, as much intuitive thinking, all of these things to try to really determine that? Because everything can change so much. You want to make sure that these other items on the checklist are taken care of, because it all points to those future prospects.
Great one. Yeah, really good job. Really good job. That was probably your Jonathan Taylor. So
yeah,
it's going to be hard for me to follow up with that. So I will do my best. So this one is, I think the one I'm going to pick next is going to be, which I think is always critically important, irregardless of what company you decide to investigate. And that is, how does the company make money? If you don't understand the business and what it is they do, it doesn't matter. You have to understand how the company makes money. And sometimes it's brutally simple. A company like Kroger, okay, they make money from selling groceries. Duh. Sometimes it's not so simple. And sometimes you have to think about a little more deeply what exactly it is they're doing. I know that Warren Buffett is famous for never investing in tech, and that was always kind of his mantra. And then he doubled down on Apple and had a huge return. on that investment. And but the thing is, he understood the business and he understood what it is that they did. He may not understand the tech. Heck, I don't understand the tech. I don't understand how the iPhone works. It's a fascinating piece of technology, but he does understand customer behavior. And because he understands that, he can understand the business, and that allows him to buy a company like an Apple, even though he's been a staunch anti-tech person up to that almost his entire investing career. So having said that, if you cannot understand what the business does and how it makes money, you have no way of knowing whether the company is doing well or not, really. Yes, you can see what, earnings are up 13%. Great. Okay. Well, what happens when earnings are down 14%? And it really has nothing to do with the business. It's macroeconomics related, or the tide went out and the company just went down with everything else. If you don't understand that, then you'll lose money. Or vice versa, if you're looking at a company and the stock market the tide does go out, but this company is still, operating on all cylinders, hitting all their marks, and you don't understand how the business works, you may miss a golden opportunity. So to me, this is numero uno, that you need to understand how a company makes money. And if you don't, then you need to go back and figure it out before you go any further.
Yeah, it would be like trying to play a game of football without having any blocking or tackling. Like, you gotta.
Yeah, you gotta.
All right, I'm going to reach. I'm going to go for a sleeper in round 2. So that'll be a big mistake because it's not going to be as gangbusters as our first 2 picks were. But I'm going to identify the key risks the business faces. This is in the financial pillar of this checklist that we are referencing. It is very easy and very natural to, once you learn how a business makes money, you learn how successful they've been, what's made them successful. It's very easy to start drinking the Kool-Aid. I've done it all the time. We all do it. If you can start at the risk factors, you almost flip the equation. You invert the way you're thinking about the company. And it can actually illuminate a lot of things about the business itself. So, for example, if you are like a vendor for Apple, let's continue with the Apple example, a company like Skyworks. Skyworks has Apple as so much of a customer, that Apple makes up so much of its business, that they have to list that concentration in their annual report. So if I was new to Skyworks and I'm trying to decide, is this something that I want to buy or not? Which, by the way, we covered really nicely. Tyler Nash did a great episode on this. Go back in the archives. We talked about Skyworks. It's a fascinating company. But if I wanted to learn everything about the ins and outs of Skyworks, and I learned about, everything that made them unique, but I didn't think about the key risks first, I might spend a lot of time that I could have spent on something else that's a better opportunity, because I didn't think about key risks. So key risks, it's not something you can perfectly do every time, and it's not going to cover everything. You'll never be able to figure out every single key risk, because that's just the way the world works. There are just risks we can't quantify all the time, but it can really help you download a big picture of the business, and hopefully management's being transparent about that. And if they are not, maybe their lawyers are. But that can kind of help you. For me, it helps me visualize, where does this company sit in the bigger picture of its industry, not just its industry, but its value chain. So that means the customers it has, the vendors it has, the people to the left and to the right and up and down from them. Can be a great way to kind of understand, for lack of like a nicer word, like the power dynamics between companies. That stuff does play a role in how companies perform. And looking at key risks can help you put your mind to that kind of stuff.
That's a great one. Heads I win, tails I don't lose that much, right? Like that whole idea Manish. To quote Monish, that's his famous phrase. And I guess when I think of risk, I always think of that, like that idea of you're trying to protect the downside, and that can be so important. Like Buffett always says, right? Rule number one, don't lose money. Don't forget rule number one, rule number two. So, yeah, I love that. All right. I'm not sure if I can top that, but I'm going to try. This is going to be more of a stretch pick, shall we say. So this is still in the business pillar, but this is one that I think is very important and probably gets glossed over a little more than it should, is does the company have a durable competitive advantage? In other words, does it have a moat? So if you tie this in with what's going on with understanding the business, the future growth, and the risk, those are all very, very critical pieces of the pie to figuring out whether this is a good investment or not. Some companies don't have a durable competitive advantage, or as Warren Buffett would call a moat, which means that they can't defend themselves against competition. And if you're trying to invest in a company that you hope is going to generate above average returns for a long period of time, it has to have a moat to do that. Because if it doesn't, if it's doing things that are successful and profitable, other people are going to try to figure out how to compete with what you're doing. Either they will try to mimic what you're doing, or somebody will come along with a better, cheaper, faster process and will disrupt what that company is doing. And so the stronger the moat is, the better the company is. And you think about a company like a Visa or MasterCard, they have some of the arguably largest moats in the world. And it's evident by the fact that there's been people coming at them for the last 20 some years and haven't been successful so far, and hopefully won't be as an investor in both companies. Hopefully they won't be for a very long time. But that's what makes those businesses so awesome. That's what makes a company like Costco so awesome, is they have this amazing moat around them. And yes, the stock price is air quote super expensive, but in part that's because people recognize that this is a really durable, competitive advantaged company, and the different layers that they have give them a strength of business. And that's why we as shoppers go there. Andrew and I have waxed poetically about Costco many times, and the benefits beyond just the hot dog and some of their great food. It's also the cheap prices, and there's many, many things that go into it. But this to me is a very, very important. So that's why I chose this as my number 2 pick.
Yeah, love that. So I'll build on that then. Staying in the financial pillar, one of the ways you can identify a moat, durable competitive advantage, is the return on invested capital, or ROIC. So this checklist item is, what is the return on invested capital for the business? This can be a great indicator of a company that's doing something really, really well and has competitive advantages. If we talk about the Costco example, what return on invested capital can do is it can tell you how efficient a company is, which tells you how easy is it for a company to grow. So let's use Costco, and then let's pretend Andrew's going to make an Onco, and he's going to try to compete against Costco. So if Costco's ROIC is like 25%, that means they're making 25% ROI when they open the store. And if Onco's ROIC is 10%, you can see I'll have to make 2.5 more store openings to be able to get a similar profitability level to Costco. And if we're in an industry where size matters and the amount of profits matters and scale matters and how many stores you get to matters, Costco's going to have an easier time because they have a higher ROIC. Why? Because they're more efficient. Why? Because they have durable competitive advantages. So it's one of these weird things where it's like, what is it? What was first, the chicken or the egg? Sometimes it can be that way. But a lot of times it can just be a great way to identify and kind of check the narrative. Like, okay, I love Costco. I shop at Costco. Is it really as great of a business as everybody on YouTube says? Well, we can look at return on invested capital and try to make that decision for ourselves. So ROIC is a fantastic metric, and you want to look at it not just on an island, but you also want to compare it to itself over time. Is it getting better? Is it getting worse? And also, like I mentioned with the whole joke about competitors, you can compare it with competitors too to try to get insight into how profitable or efficient a company is versus its peers.
That's a great pick. ROIC can tell you so much about the business and what's going on with the company. And that's going to segue me into my next pick, which is, are the CEO and CFO disciplined in making capital allocations? So as Michael Mauboussin said in one of his papers, capital allocation is job number one for a CEO. And the better they do this, the better the company is going to be. And ROIC is one of those metrics that you can use to help you measure how well a company does reinvesting their capital or making capital allocations. And the reason why this is important is because hopefully every company that is making something makes money. And if they make money, they have choices of what to do with that money. And if you're a company, if you're investing in Google, for example, you want Sundar Pichai to make great capital allocations because he's got a lot of money to play with. And the better decisions he makes, the faster and the better, arguably, that Google can grow. And a shareholder, we want to see that. It also gives them more optionality to do things like pay a dividend or buy back shares, which are also great capital allocation choices for a CEO. And one of the hard parts about it's a little squishy, if you will, to try to assess management. And because capital allocation is so important, there's not a lot of hard, fast metrics besides ROIC that allow you to look at how well management allocates capital. And the reason why this is so important is because if they don't do a good job and they burn all that cash, then eventually the company is going to struggle. Competitors are going to come for their lunch. There's going to be disruptions that they're not going to be able to fight off. And as investors, we will struggle to see a good return on our money because the company is being run poorly. And one of the challenges to finding good CEOs is finding not just people that talk well, but also can allocate capital really well. And a challenge with this is that many CEOs, once they achieve that level of management, don't come from a place where they're learning how to be a capital allocator. Maybe they came from marketing, or maybe they specialized in the operations of the business, or maybe they specialized in something else, or maybe they didn't grow up in this business. They worked in a competitor or another industry even, and they're being brought into this particular industry, and so they don't have the necessary understanding of the business or the industry, the economics, and so they're already kind of behind the eight ball. And that's one of the things that sets Warren Buffett apart among many things. But he is arguably the greatest capital allocator we've ever seen. And that's one of his strengths. And that's one of the things that when he leaves will be a top priority to figure out whether Greg Abel can, match the GOAT. And that's a tall order to achieve. So the reason why I chose this is because this is critically important for us as investors. If you invest in a company that's being run by a ham sandwich and they run it like it's a ham sandwich, then you're going to struggle to get a good return. But if you find a company that's run really well, Satya Nadella by Microsoft, that's part of his strength, is he's really good at figuring out what to do with the money. And that's why, in part, why the company has done so well since he's taken over. So that, to me, is why this is so important.
And knowing not just what to do with the money, but also when to not outlay money. Like Buffett's done a great job of that, right? Like just sitting on cash for a long time and then bam, there's Apple stock.
Right. Yeah, exactly. Or buying back shares. He doesn't see any other options. So instead of buying another company, he buys back shares. So yeah, that's awesome.
Yep. This one, I'm going to go back to the business for a second. I think if leadership management does a good job of running a business, I think this is one of the natural outflows. And some businesses are more explicit about this and public about this than others. Some managers are more explicit and public about this than others. But the checklist item is, what pain does the business solve for the customer? And this kind of gets back to, how does a business make money? And then what is their cash cow? And how is that all related? So I'm reminded of this because of some stuff I've been reading about our new favorite bank, which we're not going to say on the air. But that is one of their big missions, is they are customer obsessed. And it reminds me of Amazon back in during the dot-com boom. Jeff Bezos, everything was about the customer. They were customer obsessed to the max. And some other companies are also following with that kind of philosophy, but it really is the whole point of the business. I mean, there's shareholders, there's all these moving pieces around a business, but at the end of the day, either the moat helps you serve the customer, or the way you serve the customer is the moat. So, like with Costco, as long as they can continue to provide value to people that they can't get anywhere else, helping that family of 5 save hundreds of dollars a month on their groceries, Costco knows that that's the pain point, that the family wants to save money. And they know that as long as they continue doing what they do to save money and share that with the customer, then the moat is intact. So for every business, it's going to look a little bit different. But that's where I think the Peter Lynch quote, "Know what you own," plays into this. I think just kind of being a customer and seeing the other side of it. You can't do that with every business, because there's some B2B businesses and things like that. But having an understanding of the customer's pain points, and management needs to know what that is too, and not deviate and try to force feed a different business or mental model on a customer who doesn't want it, because that just doesn't work either. So I think it's one of those things I probably don't think about enough, and it's so basic and elementary, but it really is the key for especially consumer-facing businesses. Figure out what is the pain point, and is the company solving it, and are they continuing to solve it, or are they getting worse at that value proposition?
That's a great one. And I agree. It probably flies way under the radar more than it probably should. And if you think about the company you were mentioning, and Amazon in particular, I think that was one of the things that really set Jeff Bezos apart, was his ability to focus on the customer and what pain point are they trying to fix? What are they trying to solve? And everything that they did kind of came back to that pain point. Like, what are we trying to do here? And I think that's, his focus on that, and his obsession, I guess, is, I think, what really set them apart and allowed them to become Amazon that we know now today. So yeah, that's a great one. I'm going to go back to the financial pillar. And since I haven't really taken a bite here, I want to talk about assessing the strength or weakness of the balance sheet. So the balance sheet is, you could say all the financial statements are important. The balance sheet is as important as the income statement. The income statement probably gets the most air quote press, because people always talk about earnings, they talk about revenue, and people will talk about free cash flow, which is obviously critically important. But the balance sheet really can tell you how strong a business is. And just simply looking at what is the combination of the assets to the liabilities to the equity, and how does that relationship work? And the stronger the company is, arguably the more assets they're going to have on the balance sheet, because those are what are going to generate income or revenue for the business down the road. And you can tell a lot about a company's capital allocation priorities and where and how they choose to do things. For example, if a company is spending a lot of money on things like, they want to grow the business, they want to grow the inventory, for example, and you also see a lot of debt on the balance sheet, that could tell you that maybe the company is using the debt to finance the acquisition of all the inventory that they are hopefully going to sell. And in some cases, different business models, that can work just fine. But if you don't understand the relationship and the correlation between the two, and you aren't tracking that, you could get caught off guard. If you don't understand that maybe they're diluting themselves by issuing a lot of equity, then that could be an issue as a shareholder down the road. Well, why isn't my piece of the pie growing? It's because the company is giving away equity, and now my piece of the pie is getting smaller, and that all shows up in the balance sheet. And a real easy way to look at how all this kind of plays out, and I guess the strength of it. I don't remember which investor said this, but I read this somewhere a while ago, is simply look at the cash relationship to the debt relationship. If the company has more cash on the balance sheet than they do debt, then the company is in a pretty decent financial situation. If it's reversed, it doesn't necessarily mean it's a hard no, but it's certainly something you want to investigate further. Keep in mind, whenever we're working through a checklist and we're analyzing a company, you always want to make questions to ask yourself, what is going on here? I see that there's more debt than cash on the balance sheet. Why? How much more? And you just start digging into those questions a little deeper. And I think that can help you really understand the strength of the business. And I think, the pandemic isn't that far removed, that hopefully we haven't forgotten that the strength of the balance sheet was very evident, how important that was during that scary time period. And I think that it should have been a siren call to everybody that, hey, we need to pay attention to this. And so that's always something that I try to look at when I look at a company first. Like when I'm going through the financials, the balance sheet is one of the first places I'll look, and I'll look for those relationships and try to see how they look and what is that telling me about management. And so I think you can reveal a lot from the balance sheet.
You really can. Yeah, I love that. That can be a powerful thing. Amazing how much more powerful it is now that so many people aren't focusing on it. Definitely a great tool to have in your belt. I'll stick with the financial pillar. One of the line items here: does the company have a history of growing earnings above the market average? And I think with some of these checklist items, you don't need to answer yes to everything, and you probably won't. There will probably be places where you have a company you really like, and it's like, maybe they have a little too much debt, or, they had a bad 5-year period. The point of the checklist is to try to gather more information for yourself, and so you can understand the situation fully. So yes, obviously we want a company that has a history of growing earnings above average, but maybe there's a reason why that wasn't the case. But maybe they've done something inside of the business to turn that around, or maybe just the industry has been in a low period and it's going to rebound, and it'll only be a matter of time before the market catches up to that. So that's something I think that can tell you a lot, is what was the history of the earnings growth. And if the history is not great, I would say in both ways, whether the history was great or whether the history was kind of underwhelming, trying to figure out what drove that historical results. So if I see earnings per share doubling every 3 years, okay, was that a revenue story, or are they just really good at increasing their operating margins? Was it a margin expansion story? So though, if it's a margin expansion story, maybe that's not a growth driver in the next 5 years, even though it was over the previous 5 years, or maybe it will be. So every business will be a little bit different, but trying to see how all of that goes. And then the last kind of thing I'll add on there is divestitures, I think, can be a reason why earnings are suppressed over the short term. Look at divestitures. That can sometimes be actually a place of value add. I'm thinking of Danaher specifically. They do a lot of divestitures, so the numbers don't look great, but as a shareholder, you're getting pieces of a lot of different businesses. So you run it through a screener, you look at all the metrics, and it doesn't look as great, but it's because they do these divestitures. So doing that extra work, doing the extra homework, digging deeper can help you find more opportunities such as that.
Yeah. All fantastic points. And to your point, the divestiture idea is not something that probably gets enough love And depending on which companies you're looking at, some are going to do more than others. And that's part of, I guess, the business model of Danaher. And it's also part of the capital allocation that you can expect is, as they split off different companies, you become a shareholder, and that could be and they generally tend to, pick good companies that they acquire. And so when they divest them, that can be also beneficial as a shareholder to you because they've done a good job of building that business up. So yeah, great points. All right. The next one I'm going to throw out there is, I'm surprised this has gone under the radar. This feels more like, that wide receiver that you didn't really know and then kind of comes out of nowhere. I'm going to go with calculate intrinsic value using different methods. So this is from the valuation pillar. So a lot of people, when they think about analyzing businesses, they always generally tend to look at valuation last. I guess I'm maybe a little weird, and I generally tend to look at it earlier. And then as I do more analysis, then it tends to filter into adjusting that valuation, yay or nay. And the point about calculating intrinsic value using different methods is you have to think about intrinsic value, calculating it using different tools as different tools for different situations. You don't go fix a roof with only a hammer. You have to use other tools to do it. You don't go fix your plumbing with just a hammer. You have to use other tools to do it. And when you're calculating intrinsic value, the same idea has to apply. And so depending on the type of company, where they operate, where they are in their life cycle, will have a huge bearing on what kinds of tools you want to bring to that particular job. And the other part of it too is when you're looking at intrinsic value for a business, Andrew and I's preferred method is a DCF. We love using DCFs. We found a lot of success using those. We think it's a great tool to use for a lot of different types of businesses. But when I'm doing intrinsic value calculations, I will look at other tools to get a range of ideas or look at different things to help me get a sense of what the market is trying to portray when they're pricing in a particular company. So using a DCF is a fantastic tool, but also using a reverse DCF to see what the market is expecting or what they're pricing in can help explain maybe why they're paying, people are willing to pay more because they think it's going to grow more, or looking at multiples and comparing those multiples to other companies' multiples, to their histories of multiples, can also tell you another story about what's going on with the valuation. And I like to think of Professor Demoteran's kind of concept of narrative and numbers. And so the numbers are going to tell you a narrative, but you also have to I feel like we have to use a range of different kinds of numbers to try to get a good sense of what the valuation will be. And I guess the other part of this is always remember that when you're doing any sort of valuation work, the vast majority of it's guesswork. And we're trying to be educated about it, and we're trying to be as reasonable and logical as we can about it. Yes, it is normal to drink the Kool-Aid, but you have to try to tone it down as much as you can. And the other part of it is, don't fixate on the final number. If you do a DCF for a company and it comes back with $100 and the company is selling for $104, if you're looking to buy it, that $4 difference is probably not going to make that big of a difference if you own the company for a period of time. And I guess the other thing is, try not to fixate on the finite details of the valuation. It's more about finding a range and whether you think that's reasonable or whether you think it's exact. And what is that Buffett phrase or Charlie phrase? I'm going to blank on it. It's better to be, help me out here.
Approximately right than precisely wrong.
Thank you. Yeah. It's better to follow that advice than anything else. So yeah, that's my pick.
Yeah. Great one. Man, that was a steal. You might have won the draft on that one. But that's okay. I will still try to make it up. So the one I want to talk about here is, does management think independently and remain unswayed by what others are doing in the industry? This one can be interesting. I think depends on what industry you're in and how rational that industry is. But I will use an example. I believe it's our favorite auto insurer. But what they do is they have a very set way that they do capital allocation. So insurance companies and banks and financials, they are a little bit different in that the way you grow a financial firm oftentimes is if you want higher growth, you take higher risks. And so how that plays out in insurance underwriting is if I want to grow my revenues faster, maybe I will write policies with drivers that aren't as great. And then, that probably will bite you in the long term. But it depends. It depends. It's like the stock market. Insurance is like the stock market. There's bull markets and bear markets in the stock market. There are what they call hard periods and soft periods in insurance. And so our favorite auto insurer does something way different than the entire industry in that they have a set profit ratio that they target every single year. That means that when prices get really high, they lose out on some growth because they're not writing these insanely risky policies that everybody else is writing to chase growth. But on the flip side, when policies are cheaper, they are getting really, really aggressive when other people are pulling back and kind of reacting negatively and pessimistically to the economy. So it's been a wonderful formula for them. There's a few other examples of CEOs who think completely differently than the crowd. One guy who's really hated, so I won't mention him, but he's a little political. But anyway, like these type of leaders can help you find businesses that really stand out from the crowd, and that can be a great way to find good investments.
Yeah, fantastic way. I'm going to stay in the management pillar, and I'm going to talk about, does management have a plan, and do they communicate that plan? This goes to what you really want to know when you're investing in a business, when you're handing over your hard-earned money. Do they understand the map, and do they know where they're going, and do they have a plan on how they're going to get there? And not every company is going to have a hunky-dory, rosy quarter every single quarter. Businesses, if you watch them long enough, are going to go through ebbs and flows. They're going to go through times of boom and times of bust. And it's really important to have a CEO that understands what's going on in their business, is not detached or tone deaf or don't have a plan. And if they don't have a plan, then they're going to go off the map and they're going to struggle to get to their destination. And so when you're listening to earnings calls, this is one of the better times to hear what is management doing and where are they planning to go. And the good ones, kind of to what Andrew was talking about earlier, just a minute ago, the good ones will communicate what they're trying to do and how they're planning on doing that. And the good ones will tell you, okay, we're going to do this. We're going to focus on this part of our business because this is core to our business. And we're going to focus on this, and we're going to do these things. And this is what we expect to happen when we do these things by focusing on this part of the business. And then you as a shareholder have the responsibility the next time they report earnings, or the next, over the next few quarters, a year, is, are they talking about that, and are they executing, and are they hitting those plans or those goals? And that tells you that, hey, this is a good management team. These are people that I can trust, and these are people that I can give my money to, and that are going to do the best for me that they can as they communicate and execute on their plan. And there's nothing worse than having investing in a company, listening to an earnings call. They've had a horrible quarter, or maybe 2 or 3 quarters that have been horrible, and you just listen to them blather on about things that have nothing to do with what's going on in the business, and you can tell immediately that they really don't have a plan and they don't know what they're going to do. And that is the worst place to be. So that's why this is super important to understand and have a good sense of what management's trying to do. Because if they don't have a plan and they don't communicate it to you, then how are you supposed to know what they're going to do and where they're going to go?
Yeah, I love that. I'm not sure if I have much to add. Da-na-na, na-na-na. I think that might be. I think the draft might have just concluded, unless you have one more you want to hit on.
I do not. I think all of these are probably a really good overview of the lists that Monish created for us, and I think this could be super helpful for people that are newer and people that have been investing for a while. There's a lot of great insight in this, and hopefully people enjoyed our draft.
Right. The blog post you wrote, which is very well written, Monish Pabrai's stock buying checklist. You can go to our website and just put that in the search bar. Should pop up for you, and you'll get to see all 34 items. That's quite a hefty checklist. You should know a lot about the business you're looking at if you went through every single one of those.
Yeah, absolutely. All right. Well, with that, I will go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.
We hope you enjoyed this content. 7 Steps to Understanding the Stock Market shows you precisely how to break down the numbers in an engaging and readable way with real-life examples. Get access today at stockmarketpdf.com. Until next time, have a prosperous day. The information contained is for general information and educational purposes only. It is not intended for a substitute for legal, commercial, and/or financial advice from a licensed professional. Review our full disclaimer at einvestingforbeginners.com.